and welcome to episode 101 of Mo Money, the investing economic show for millennials by a millennial, where our goal is to educate, entertain, and increase the financial literacy of a whole new generation of investors. I am, of course, continuing to be the host. Just signed a big fat contract for another 100 episodes. I am MC Mo. Now let's get to the money. Yesterday, September 19th, the Federal Reserve announced that they would be cutting the federal funds rate by 25 basis points. A quick TMO, aka a teaching moment, a basis point is 0.01%. So if the yield on a bond is 100 basis points, it means you get 1% interest on the bond. So why not just say it like that? Well, to quote The Big Short, Wall Street likes to use confusing terms to make you think only they can do what they do. This is the second cut since the financial crisis. The federal funds rate now stands at 1.75 to 2%. So why is this a big deal? Well, the first question is, if the economy is doing so well like Trump and the Federal Reserve tepidly claim it is, then why is the Federal Reserve cutting rates? A monetary policy tool that is normally reserved for when the economy is experiencing a downturn. The second question is, with such a short distance from 2% to 0, will the Federal Reserve be able to spur enough stimulus when the next downturn does come, whether that's next month, next year, or it's already started? 0%, you can't go any lower than 0, right? But what if you could go lower than 0? What if you can go into negative territory? That is the topic of this week's episode, negative interest rate policy, aka NIRP. In the midst of the Great Recession, the Federal Reserve cut the interest rate from 5% all the way to roughly 0%. This was meant to encourage lending and the creation of credit in the economy. Without nitpicking or being too cynical, you could say that they were correct and that the plan worked. Lowering the rate to 0% did help prevent a total economic depression, and with the help of $1 trillion in quantitative easing programs, set the economy back on a path of steady growth. But here we are, 10 years later, and all things considered, the employment is not that bad right now. Inflation is low, unemployment is low, and wage growth is up. But yet, for numerous reasons, some of them Trump's fault, some of them, just economics, things are a little uneasy in the markets. And Trump, knowing his re-election is on the line, is demanding the Fed lower their rate to match the rate with other central banks and make us more competitive. When rates go lower, money flees that country in search of higher returns elsewhere. This causes that country that the money is fleeing to see its currency lose value. And when the currency loses value, exports increase because stuff becomes cheaper for people to buy. And Trump wants to win the trade war across the globe. China, with Europe, everybody. He just wants to total domination. Central bank interest rates and the price of a bond have an inverse relationship. When the rates go up, the bond prices go down, and vice versa. So as central banks cut their rates lower, the prices of bonds go up, and some have even started having negative returns. So why would anybody buy a bond knowing that they are certainly going to lose money? Why would anybody buy a government bond with a negative yield, meaning they are essentially paying the government for the honor, for the privilege of lending them money? Nearly a quarter, 25% of the global bond market currently has negative yields. So what the fuck is everybody thinking? One reason that they're buying these bonds is for a quick and profitable trade. If you buy a government bond for $100 today that doesn't expire for another 30 years, and the government lowers their interest rate, that increases the price of the bond to the point that if you sell it, even though it has a negative yield, you still made money. Another reason is that the government bonds are still considered safe assets. So if people buy them, even though they have a small negative yield, it's better than putting your money into something much more risky that could lose you a lot more, if you're unsure about where the economy is going in, the next year or two. And the negative yield on the bond, might not last forever. It might eventually turn positive, so might as well just buy it because at least the government's going to guarantee it. A third reason is to meet capital requirements. The banks are required to have a certain amount of safe assets on their books to backstop the losses of any risky investments that they may also have on their books. Government bonds and cash are considered to meet the standards of these capital requirements. A fourth reason is some of the larger financial institutions are required to buy government bonds. They are called the primary dealers, the Goldman Sachs and JP Morgans of the world. This is to help create a market and make sure that there are buyers and sellers for these bonds. So they do not have a real choice of what rates the Treasury is going to issue them at. They basically just have to shut up and buy them. Here's the bottom line. Everything in a nutshell. Negative rates are a monetary policy tool meant to be used during a recession or to prevent a recession, not as a long-term policy. They said the same thing with 0% or ZIRP, but that lasted for 8 years. But in the event of a crisis, going to negative yields, theoretically, It makes sense because it causes banks to generate loans and stimulate the economy instead of hoarding money at their central bank. But if there's no safe loans to make and they store the money at the central bank and they lose money that way, then they have less money to give out for loans when there is a good idea or when the economy is doing a little bit better. It becomes this perpetual cycle, and the banks and the economy will be stuck between a rock and a hard place. And if rates stay negative long enough and it affects regular depositors, aka you and I, why would we put our money in the bank? Fuck that. We'll just hold all our money in cash, and if we don't put our money in the bank, then the banks have absolutely no money to lend out to generate economic growth, and then we're stuck in another bad situation. So as you can see, negative interest rate policy involves perfecting a delicate balancing act between too much and too little reduction in rates, and knowing when to raise them and when to keep them the same and when to lower them. That's a balancing act that I personally think no group of the smartest economists can master. But, what do I know? I am just a man with a YouTube show. Thank you so much for watching another episode. You can find new and classic episodes of Mo Money right here on YouTube. For now, don't forget to like, comment, subscribe, share, follow me on Twitter, follow me on Instagram, like me on Facebook. Mo Money, signing the fuck out.